You're going to lose everything, not because the market's crashing, because you're too stupid to know what to do when it does. I don't care if you think you're smart. I don't care if you've been investing for 20 years. When 2026 hits and the correction everyone's whispering about finally arrives, 90% of you will make the biggest mistake of your financial life. You'll panic, you'll sell, you'll lock in losses that will haunt you for decades. But Kevin O'Leary, Mr. Wonderful himself, the guy who's built a fortune while amateur investors cry themselves to sleep, he's doing the exact opposite. He's buying, aggressively, strategically, 5 specific stocks. But before I tell you which ones, you need to understand why everything you think you know about market downturns is dead wrong. Let me be crystal clear about something. Kevin O'Leary isn't some YouTube guru telling you to buy meme stocks and pray. This is a man who chairs O'Shares Investment Advisors, a man who sits on CNBC and Shark Tank and calls out garbage investments to their face, a man who's seen multiple recessions, multiple crashes, multiple moments where weak investors got slaughtered while he got rich. And his philosophy on market downturns is brutally simple. When everyone else is selling in a panic, that's when you buy quality at a discount. Here's what the data shows. In 2025, the market experienced sharp volatility, tariff concerns, geopolitical tensions, interest rate uncertainty. The S&P 500 has been on a roller coaster, and analysts at Goldman Sachs, Fidelity, and major investment banks are all saying the same thing. 2026 could bring more turbulence. Valuations are stretched. The Magnificent Seven tech stocks are trading at price-to-earnings ratios that would make your grandfather's generation laugh out loud. We're talking Apple at a PE of 29.69 with only 7.6% expected earnings growth. Tesla at a PE of 183.26. Microsoft at 38.29. These are bubble-level numbers. But here's where Kevin O'Leary separates himself from the herd. While amateur investors see danger and run for the exits, O'Leary sees opportunity. He doesn't time the market. He doesn't try to predict the exact bottom. He doesn't panic sell when CNBC puts up red graphics and scary headlines. Instead, he follows 3 non-negotiable principles. Number 1, he only buys quality companies with strong financial performance and rock-solid balance sheets. Number 2, he demands diversification across different market sectors. And number 3, the most important one, he insists the stocks he invests in pay dividends to shareholders. Cash flow, real money, not promises, not hype, dividends. This isn't theory. This is the exact strategy behind his O'Shares FTSE Quality Dividend ETF. The fund holds companies that exhibit all 3 qualities: market leaders, strong profits, diversified business models, and they pay dividends. When the market crashes, these companies don't just survive, they thrive. And smart investors who buy during the panic make fortunes. Now let me destroy a myth that's going to cost most of you a fortune. The myth that you should sell before a downturn and buy back in at the bottom. Kevin O'Leary has called this the single biggest mistake investors make. And he's backed this up repeatedly in interviews on CNBC in his public statements. He's gone on record saying that trying to time the market is impossible. You thought stocks were overvalued 2 quarters ago? You would have sold and missed out on massive gains. The market doesn't care about your feelings. It doesn't care about your predictions. Here's the cold hard truth that O'Leary hammers home. In 2025, during periods of market turmoil, he stated publicly that he doesn't panic when stocks slide. While Canadian and American investors saw sharp market swings from tariffs and geopolitical concerns, O'Leary maintained his disciplined investment approach. He buys indices. He favors rule-based exchange-traded funds that provide broad market exposure. He doesn't pick individual stocks to trade in and out of based on fear. He holds quality dividend payers through the storm. Why? Because downturns are temporary. Quality is permanent. Let me give you a concrete example. During the 2008 financial crisis, the worst market crash since the Great Depression, quality dividend stocks got hammered along with everything else. Investors panicked. They sold. They locked in catastrophic losses. But companies like Microsoft, Johnson & Johnson, Visa, these companies didn't disappear. Their business models didn't evaporate. They kept paying dividends. They kept generating cash flow. And investors who bought during the panic, who had the courage to deploy capital when there was blood in the streets, they made generational wealth. O'Leary's advice during the 2025 market turmoil was consistent with his long-term philosophy. Don't try to predict the exact bottom. You can't. Nobody can. Instead, when you see quality companies trading at discounts because the market is having a tantrum, you buy. You dollar cost average, you accumulate shares, and you collect dividends while you wait for the inevitable recovery. Here's another critical point. O'Leary warns investors about the tax trap of panic selling. Let's say you bought a stock and it's up significantly. Then the market starts to decline. Your position drops from a big gain to a moderate gain. Some investors think, I'll sell now, take the profit, and avoid further losses. But O'Leary calls this financial suicide. Why? Because you trigger a taxable event. You pay capital gains tax on that profit. Then you sit in cash, watching the market potentially recover without you. And when you finally decide to buy back in, you've lost money to taxes, lost potential dividend income, and probably bought back at a higher price. It's a triple loss. The O'Leary philosophy is ruthlessly simple. Buy quality, demand dividends, hold through volatility. Don't try to be a hero. Don't try to time the market. Let compound interest and dividend reinvestment do the heavy lifting. This approach has made O'Leary wealthy. It's made his investors wealthy. And it's exactly the opposite of what 90% of retail investors do when markets get scary. Which brings us to the 5 specific stocks that embody this philosophy. 5 companies that Kevin O'Leary holds in his O'Shares portfolio. 5 stocks you should be buying, not selling, when the 2026 downturn arrives. Stock number 1, Microsoft, ticker symbol MSFT, current dividend yield 0.8%, portfolio weighting in O'Leary's O'Shares fund 4.7%. Now I know what you're thinking, Microsoft has a PE ratio of 38.29. That's elevated, it's expensive. Why would O'Leary recommend buying this during a downturn? Here's why. Because when you strip away the noise and look at the fundamentals, Microsoft is a cash-generating monster that becomes even more valuable during economic uncertainty. Let's look at the numbers. In late October 2025, Microsoft reported financial results for the first quarter of fiscal 2026. Revenue grew 18% over the prior year. 18% growth for a company with a market capitalization over $3 trillion. That's extraordinary. Sales of Azure, Microsoft's cloud platform, grew 40%. 40%. In an environment where many tech companies are struggling, Microsoft is accelerating. Earnings per share grew 23%, from $3.36 to $4.13. And they didn't just meet analyst expectations, they exceeded the consensus by 47 cents. Microsoft has beaten analyst estimates in 27 of the last 29 quarters. That's not luck, that's operational excellence. Here's what makes Microsoft a Kevin O'Leary stock. First, it has a rock-solid balance sheet. The company has minimal debt relative to its cash generation. Second, it's diversified. Cloud computing with Azure, productivity software with Office 365, gaming with Xbox, LinkedIn, GitHub. If one segment faces headwinds, others compensate. Third, and this is critical, Microsoft pays a dividend. It's not a high-yield dividend, but it's consistent and growing. The company has increased its dividend annually. For a company of Microsoft's size to deliver 18% revenue growth while paying dividends and buying back shares, that's exactly what O'Leary looks for. Now here's the downturn opportunity. If the market corrects in 2026 and Microsoft's stock drops 20, 30, even 40%, does the business fundamentally change? No. Companies still need cloud infrastructure. Enterprises still need productivity software. Azure's growth trajectory doesn't disappear because the stock market has a panic attack, but the valuation becomes dramatically more attractive. A 38 PE becomes a 27 PE. Suddenly, you're buying a dominant technology platform at a discount, and you're collecting dividends the entire time you hold it. O'Leary's strategy with stocks like Microsoft is to accumulate during weakness. When CNBC is showing red screens and analysts are downgrading tech stocks across the board, that's when you buy. Not with your entire portfolio at once. You dollar cost average. You buy a position. If it drops more, you buy more. You average down, and you hold. The competitive moat here is enormous. Microsoft competes with Amazon Web Services and Google Cloud, but Azure has differentiated itself through enterprise relationships and integration with Microsoft's existing software ecosystem. Regulatory concerns exist, but Microsoft has navigated antitrust issues before. The real risk is a slowdown in cloud spending, but even if growth moderates from 40% to 20%, that's still exceptional for a company of this scale. Bottom line on Microsoft, Kevin O'Leary holds this in his portfolio because it checks all 3 boxes: quality company, diversified business, dividend payer. When the 2026 downturn hits, this is a stock you buy, not sell. Let the amateurs panic. You accumulate shares and collect dividends while you wait for the inevitable recovery. Stock number 2, Visa, ticker symbol V, current dividend yield 0.8%, Portfolio weighting in O'Leary's fund, 4.7%. Visa is the ultimate economic toll booth. Every time someone swipes a credit or debit card, Visa takes a cut. And unlike most businesses, Visa doesn't take credit risk. They don't lend money. They process transactions. It's a beautiful business model that prints cash in good times and bad. Let's examine the numbers. In October 2025, Visa announced a 13.6% increase to its dividend. That's a significant raise, and it signals management's confidence in future cash flows. The company also reported fourth quarter 2025 results: revenue of $10.7 billion, adjusted net income of $5.8 billion, adjusted earnings per share of $2.98, marking increases of 11%, and 14% respectively. These gains were driven by a 9% increase in payment volume, a 12% gain in cross-border volume, and a 10% gain in processed transactions. Visa processed 67.7 billion transactions in the quarter, 67.7 billion. Now here's what makes Visa a fortress during downturns. The business model has no inventory, no manufacturing, no physical stores. It's a digital network. The operating margins are absurdly high. When economic activity slows, transaction volumes might decline slightly, but Visa's cost structure doesn't increase. The network still operates, the infrastructure is already built, and as O'Leary always emphasizes, the company returns massive amounts of cash to shareholders. During the quarter, Visa returned $6.1 billion to shareholders via dividends and share repurchases. They repurchased 14 million shares of Class A common stock for $4.9 billion. They still have $24.9 billion available on their share repurchase authorization. Here's the downturn play. In a recession or market correction, consumer spending typically declines. People pull back, credit card usage might slow, but here's the thing, Visa doesn't disappear. People still need to buy groceries, pay bills, make purchases, and increasingly those transactions are digital. Cash usage has been declining for decades. Even in a recession, the long-term trend toward digital payments continues. If Visa's stock drops 30% because the market is pricing in a recession, you're getting a world-class business at a fire sale price. O'Leary loves Visa because it's a global network with a competitive moat that's nearly impossible to replicate. Building a payment processing network that merchants and banks worldwide trust, that takes decades and billions of dollars. Visa and MasterCard have duopolistic positions. New competitors struggle to gain traction. Even with emerging fintech companies and cryptocurrency, Visa has adapted. They've partnered with crypto platforms. They've invested in new technologies. The network effect gets stronger over time. The dividend story here is compelling. 0.8% doesn't sound exciting. But remember, Visa just raised the dividend by 13.6%. That dividend grows every year, and Visa's cash generation allows for massive share buybacks, which increase your ownership stake without you doing anything. Over time, this combination of dividend growth and buybacks compounds wealth. Kevin O'Leary holds Visa because when the market panics and financial stocks get sold indiscriminately, Visa becomes a gift. It's not a bank taking credit losses, it's a payment processor collecting fees. When 2026 brings volatility, this is a stock you accumulate aggressively. Let the market give you a discount on a business that will be processing transactions 50 years from now. Stock number 3, Johnson & Johnson, ticker symbol JNJ. Current dividend yield 2.5%. Portfolio weighting in O'Leary's fund, 4.6%. This is the definition of a defensive, recession-resistant business. Healthcare, pharmaceuticals, medical devices, products people need regardless of economic conditions. And Johnson & Johnson has been paying dividends for over 60 consecutive years. That's not a typo. 60 years of uninterrupted dividend payments and annual increases. Let's look at recent performance. In October 2025, Johnson & Johnson reported third quarter results for the period ending September 30th, 2025. Revenue grew 6.7% to $24 billion, which was $240 million more than expected. Adjusted earnings per share of $2.80 compared favorably to $2.42 in the prior year and was 4 cents ahead of estimates. Revenue for innovative medicines grew 6.8% on a reported basis. Oncology, which includes cancer treatments, grew 21.3% due to ongoing high demand for Darzalex, which treats multiple myeloma. Revenue for medtech, medical devices, and equipment grew 6.8% on a reported basis. Here's why Johnson & Johnson is a Kevin O'Leary core holding. First, the business is diversified within healthcare: pharmaceuticals, medical devices, consumer health products. If one segment faces pricing pressure or regulatory challenges, others compensate. Second, the products are essential. People don't stop treating cancer because the stock market crashes. Hospitals don't stop buying surgical equipment because GDP growth slows. Third, the dividend. 2.5% yield with 60-plus years of consecutive increases. That's a dividend king. Companies that achieve this status have proven their ability to navigate recessions, wars, financial crises, and still reward shareholders. Now let's talk about the downturn opportunity. Healthcare stocks often get sold during broad market corrections. It's indiscriminate selling. Index funds liquidate. Retail investors panic. Institutional investors reduce exposure across the board. But the fundamentals of Johnson & Johnson's business don't deteriorate. Darzalex demand doesn't disappear. Surgical procedures still happen. The innovation pipeline continues. What changes is the stock price, and that creates opportunity. O'Leary's approach with a stock like Johnson & Johnson is to view it as a wealth preservation tool with income generation. When you're building a portfolio designed to survive and thrive during downturns, you need stocks that won't cut dividends. Companies that have paid dividends for 60 years don't suddenly stop because of a recession. Johnson & Johnson actually increased dividends during the 2008 financial crisis, during the 2020 pandemic crash. During every major market event in recent history, that reliability is what O'Leary demands. The valuation story is also compelling. Johnson & Johnson doesn't trade at crazy multiples. It's not a speculative tech stock. The PE ratio is reasonable. The dividend yield is attractive. The growth rate is modest but consistent. This is a stock that won't make you rich overnight, but it will steadily compound wealth over decades. And during a 2026 downturn, when Johnson & Johnson stock potentially drops 15 or 20%, you're buying a healthcare giant at a discount while locking in a higher dividend yield. Kevin O'Leary holds Johnson & Johnson because it represents everything his investment philosophy stands for: quality, stability, dividends, recession resistance. When amateur investors are selling healthcare stocks to raise cash or cut losses, that's your signal to buy. This is a company that will be paying dividends when your grandchildren are investing. Stock number 4, Home Depot, ticker symbol HD, current dividend yield 2.6%. Portfolio weighting in O'Leary's fund, 4.1%. Now here's where some of you are going to push back. Home Depot, during a housing market downturn, when interest rates are elevated and real estate transactions are slow? Yes, exactly. Because this is where amateurs get crushed and smart investors get rich. Let's examine the fundamentals. Home Depot was founded in 1978 and has grown into a juggernaut home improvement retailer with over 2,300 stores in the United States, Canada, and Mexico, generating around $153 billion in annual revenue. In September 2025, the company completed its acquisition of GMS Inc., a specialty building products distributor, for $110 per share, for a total enterprise value of roughly $5.5 billion. This merged GMS into SRS, creating a network of over 1,200 locations and a fleet of over 8,000 trucks capable of making 10,000-plus job site deliveries per day. In November 2025, Home Depot reported third-quarter results. Sales of $41.4 billion, up 2.8% year over year. Comparable sales in the quarter rose 0.2%. Net earnings equaled $3.6 billion, or $3.62 per share. Average ticket, the amount customers spend per transaction, improved 2% from $88.65 to $90.39. Customer transactions fell 1.4%, but the higher ticket offset the decline. Now here's the contrarian thesis that Kevin O'Leary understands. Home Depot isn't just about new home construction. In fact, the majority of Home Depot's business comes from home improvement and repair projects. When housing markets slow and people can't afford to move, they renovate, they remodel kitchens, they upgrade bathrooms, they fix roofs, they maintain their properties. This is counter-cyclical behavior. During the 2008 housing crash, Home Depot survived and eventually thrived because homeowners who couldn't sell invested in their existing properties. The acquisition of GMS is strategic. It expands Home Depot's presence in the professional contractor market. This isn't retail DIY weekend warriors. This is builders, contractors, and tradespeople who buy in volume. These are consistent, high-margin customers, and the infrastructure of 1,200 locations and 8,000 trucks creates a competitive moat. Smaller competitors can't match that distribution network. O'Leary holds Home Depot because it pays a solid dividend, 2.6%, and the company has a history of increasing dividends annually. The balance sheet is strong. The business generates massive free cash flow. And during market downturns, when Home Depot's stock gets sold off because investors fear housing market weakness, the valuation becomes compelling. Here's the play. If Home Depot's stock drops 25 or 30% during a 2026 correction, you're buying a dominant home improvement retailer with over 2,300 stores, strong professional contractor relationships, and a growing acquisition footprint at a bargain price. The dividend yield increases, you lock in income. And when the housing market eventually recovers, which it always does, your position appreciates significantly. Kevin O'Leary isn't afraid of cyclical stocks if they have strong fundamentals and pay dividends. Home Depot fits that profile perfectly. When the downturn comes and housing stocks get crushed, that's your opportunity. Buy quality at a discount. Collect dividends. Wait, stock number 5, Alphabet, ticker symbol GOOGL. Current dividend yield 0.3%. Portfolio weighting in O'Leary's fund 6.6%. This is the largest holding in his portfolio, and for good reason. Alphabet, the parent company of Google, is a technology conglomerate that operates businesses including Google Search, Android, Chrome, YouTube, Gmail, Maps, and many more. Alphabet is a leader in nearly every area of technology it operates in. In October 2025, Alphabet reported third quarter results for the period ending September 30th, 2025. Revenue grew 16% to $102.4 billion, which was $2.21 billion ahead of estimates. Adjusted earnings per share of $2.87 compared very favorably to $2.12 in the prior year and was 60 cents better than expected. 60 cents. That's a massive beat. Let's break down the business segments. Google Search, the largest contributor to results, improved 14.5% to $56.6 billion. YouTube ads grew 15% to $10.3 billion. Google subscriptions, platforms, and devices was up 20.8% to $12.9 billion. In total, Google advertising was higher by 12.6% to $74.2 billion. Google Cloud grew 33.5% to $15.2 billion. Here's what O'Leary sees in Alphabet. It's a cash-generating machine with multiple revenue streams. Search advertising is the core, and it's incredibly resilient. Even during recessions, businesses still need to advertise. They might reduce budgets, but they don't eliminate them. And Google Search is the most effective advertising platform in the world. YouTube is the second largest search engine globally and dominates video content. Google Cloud is growing rapidly and competing directly with Amazon and Microsoft. The Android ecosystem powers billions of smartphones worldwide. The dividend story is emerging. Alphabet only recently started paying dividends, so the 0.3% yield is low. But the company has massive free cash flow and is returning capital to shareholders through both dividends and share buybacks. During the third quarter of 2025, Alphabet repurchased $11.5 billion worth of stock. Year to date, they've repurchased $40.2 billion. That's enormous capital return. Now here's the downturn thesis. Alphabet faces regulatory challenges, antitrust concerns, potential breakup discussions. These headlines create fear and volatility, but the business fundamentals remain incredibly strong. If Alphabet stock drops 30 or 40% during a 2026 market correction because of regulatory fears or broader tech sell-offs, you're getting a dominant technology platform at a fire sale price. O'Leary holds Alphabet as his largest position because he believes in owning market leaders. Google isn't going anywhere, search isn't being replaced, YouTube isn't losing relevance, cloud computing isn't slowing down. These are long-term secular growth trends. And when the market panics and sells Alphabet indiscriminately, that's your buying opportunity. The risk here is regulatory action. If the government forces a breakup of Alphabet, that creates uncertainty. But here's the counter-argument. Even if Alphabet is broken up into separate companies, each individual business is valuable. YouTube as a standalone company would be worth hundreds of billions. Google Cloud as a standalone company would compete directly with AWS. The sum of the parts might actually be worth more than the whole. Kevin O'Leary holds Alphabet because it's a quality business with diversified revenue streams and massive cash generation. When 2026 brings volatility and tech stocks get hammered, this is a stock you accumulate. Now let's talk about execution. How do you actually implement Kevin O'Leary's strategy when the 2026 downturn arrives? Because knowing which stocks to buy is only half the equation. The other half is having the discipline and plan to execute when your emotions are screaming at you to sell. First, you need dry powder, cash. O'Leary doesn't advocate being fully invested at all times. If you believe a correction is coming, it's smart to hold some cash reserves. Not to time the market perfectly, but to have capital available to deploy when opportunities arise. How much? That depends on your situation. But having 10 to 20% of your portfolio in cash or short-term treasuries gives you firepower. Second, you dollar cost average. This is critical. You don't try to catch the exact bottom. Let's say the market starts correcting in early 2026. Microsoft drops 10%. You buy a small position. It drops another 10%. You buy more. It drops another 15%. You buy more. You're averaging down. You're accumulating shares at lower and lower prices, and you're collecting dividends the entire time. Third, you focus on quality and dividends. This is O'Leary's non-negotiable principle. Don't chase speculative stocks during a downturn. Don't buy unprofitable companies hoping for a turnaround. Stick to businesses with strong balance sheets, diversified revenue streams, and consistent dividend payments. The 5 stocks we covered today all meet these criteria. Fourth, you ignore the noise. CNBC will have red screens. Headlines will scream about market crashes. Analysts will downgrade everything. Your neighbors will tell you they're selling. Your friends will panic. You tune it all out. You stick to your plan. You buy quality at a discount. Fifth, you think in decades, not days. O'Leary's investment philosophy is built on long-term wealth creation. He's not trying to make a quick buck. He's building generational wealth through dividend reinvestment and compound growth. When you buy Microsoft at a 30% discount during a downturn, you're not planning to sell it in 6 months. You're holding it for 10, 20, 30 years. You're collecting dividends. You're reinvesting those dividends to buy more shares. You're letting compound interest work its magic. Sixth, you rebalance strategically. During a downturn, some stocks will fall more than others. Maybe Johnson & Johnson only drops 15% because it's defensive, but Alphabet drops 40% because tech gets hammered. This is an opportunity to rebalance. Sell some of your defensive positions that held up well and buy more of the beaten down quality stocks. You're not panic selling. You're strategically reallocating to take advantage of price dislocations. This is the O'Leary playbook. It's not exciting. It's not glamorous. It won't make you rich overnight, but it's how wealth is built. It's how fortunes are made. And it's the exact opposite of what 90% of investors do when markets crash, which is why 90% of investors underperform. So here's your choice. When 2026 brings the market correction that everyone's expecting, you can panic and sell like the amateurs. You can lock in losses and watch from the sidelines while smart investors get rich, or you can follow Kevin O'Leary's proven strategy, buy quality, demand dividends, hold through volatility. The 5 stocks we covered today, Microsoft, Visa, Johnson & Johnson, Home Depot, and Alphabet, these are the companies O'Leary holds in his portfolio. These are the businesses built to survive and thrive during downturns. The opportunity is coming. The question is whether you'll have the courage to act. Now get out there and build wealth.